hold your left mouse button down and look at the value of the 21-day exponential moving
Sure.
average.
Right now it's 141.56.
Okay, so just make a note of that. I'm gonna write it down. So 141.56. That's gonna
I
come
got
into
it too.
play as I explain the
Oh,
trade
okay.
here. So all right. So again, the trade, it's a bull put spread on Amazon, and even if you don't trade option, Amazon is a stock that you could trade the equity too. So either way, it works for you. That's what I try to do in these option trades. So I've got Amazon here. I like to go out closest to 45 days as far as the expiration. So 53 days out is the closest to the 45-day ideal time frame. So that's going to take us to the January 19th, 2024 expiration. So let me click on that. And then I'm going to scroll down here and I'm going to start by selling the 142.5 put here. So it's a bull put spread. Click on that to sell that. And then for protection, I'm going to be buying the 137.5. So that's going to give us a credit of 113. So the credit has dropped. So I'm going to raise that up to the numbers that I've got. So based on numbers I want to see, what I've been looking for, $1.24 is our credit. So let's take a look at the numbers here. So I'm going to click on confirm and send. And then that break even. Remember, this is why I wanted to make a note of that break even before we went to the discussion about it, because you see the break even is right about the same. So 141.56 is what's on the chart. 141.26 is the break even. So I'm not going to be using, many times I'll use the break even as my stop loss, but in this case, I don't want to do that because it could find support at that 21-day exponential and then take off. So I'm not going to be using the break even as my stop loss here. So again, that's why I wanted to explain or take a look at that, where that 21-day exponential was. So 141.26, that's our break even. Our max profit is the credit received. And now let's take a look at the other numbers. So we're going to calculate the probability of success, our return on risk, and how many contracts are we going to buy based on the numbers that we see here. So I'm going to click on that, and on the left side, I've got some notes. So probability of success is a two-step process to calculate that. First, start off with the actual risk. So to determine that, we take the width of the spread, which is $5, minus the credit received, which is $1.24. So that's going to give us an actual risk of $3.76, or in option terms, we'll always multiply by 100, $376. So that $376, that's your actual risk. Step two in probability of success is we take the actual risk divided by the width of the spread, and that's going to give us a probability of success of 75.2%. So pretty good number. I like to be in the upper 60s and the 70s. So pretty good probability of success in this trade so far. So next, we're going to calculate our return on risk. What can we expect if we hold this till expiration, which would be 53 days out? So to determine that, we take the credit received, which is $1.24, divided by our actual risk, which is $3.76. That's going to give us an actual risk of 32.9, or let's call it 33%. All right. So based on the numbers we saw, how many contracts are we going to buy or purchase with this trade here? So to determine that, we've been using $2,500 as the monies we want to put into a trade. So this is all based on your level of risk, your portfolio size, etc. So we take that $2,500 divided by our actual risk, which is $376. That's going to give us 6.65, or 6 contracts. Now, what are we going to do to manage the trade? As I mentioned a moment ago, normally I like to use the break even as the stop loss, but in this case, it's that stop loss and the break even corresponds with the 21-day exponential. So I'm not going to use that as my stop loss. So one of my personal sell rules, if I get 2 closes below the 21-day exponential, that's when I start taking some money off the table. So I either sell a part of the trade or the entire trade. So I have to wait and see if it does. So again, that's 2 closes below the 21-day. The other part of managing the trade is we're going to take profits at 50% of the credit received. In this case, it's going to be 62 cents. We're also going to manage the trade at 21 days to expiration. So I'm going to keep an eye out on this number. So if I'm still in the trade, this number is at 21, then I'll take a look and say, okay, where am I? Is the trade down? Is it not working? Do I just need to get out of it and move on and look for something else? Or maybe rather than the 50%, maybe I'm only at 40%. Well, I say, okay, 21 days, I'm just going to take that 40%, 40 cents and move on. And then the profits. If the trade is up 30% or more in the first 3 days of the trade, I'll close it out. And typically, I'll just close out the entire trade. I might put it back on, but if I'm 30% or more in the first 3 days, then I'm going to take the money and run. So again, let's change our numbers here. So 6 contracts, that's what we're going to do here. So let me change that number. And let's go to confirm and send. So again, there's our break even, there's our max profit based on the number of contracts. And then here's the buying power effect. So close to the $2,500. Now I'm going to send this off. Most likely I'm not going to get filled because I was looking at the numbers. The credit has dropped, but I might adjust it later on today. But I'm going to click on confirm and send that off. And I'll be monitoring the trade later on to see if I get filled or do I need to adjust my numbers here. And that's the trade for today.
What are some of the benefits of just holding out a little bit longer? I mean, a 30% gain is great, but what about a 70 or 80% gain?
Yeah, and I always operate on the old expression: bulls and bears make money, but pigs get slaughtered.
Sure.
So I say if I get that kind of profit in that short a period of time, I'll take it. And I may not sell the entire position. It depends on the market. The way the market is now, I'll probably take maybe half of it off and let the rest of it work. 2 months ago, when the market wasn't doing so well, then if I got a 30% gain, I would take the entire position off. But that 30%, that's just something where I say again, bulls and bears make money, pigs get slaughtered. So don't want to get greedy, because one thing is that you hate to see is, you have a nice profitable trade and you wait to squeeze a little bit more out, and then you start giving back some. And I just hate that situation. So I'd rather just kind of take the money and run and look for something else somewhere else.
Yeah, especially sometimes, it's you've got so much, so little left to gain, especially as you get close to the expiration, there's just not much of a credit left, it's not worth that much. And so, yeah, you're getting an extra $5 or whatever. And, you stand to lose potentially all of the gains that you made.
Right.
So
what's that expression? It's the juice is not worth the squeeze or something like that. I don't know exactly what it is, but
you can only squeeze a lemon so many times. Yeah.
Right.
Hey, Harold, could you show one of your cute little gold-plated bulls that you have on your desk? Because I wanted to show you my tiny little pig, which reminds me of that expression. Yeah. Bulls make money, bears make money, but pigs, which I got from Citibank. Actually, it's a red pig, not edible plastic. But yeah, it's such a very good point, and really enjoyed that trade analysis. Any final comments about, well, if someone wanted to do an even longer term bull put spread, do you have any suggestions, or would it be just based, after you've closed the trade, maybe keep watching Amazon, keep watching market, and then set up a new one that could go out 2 months or so out?
Yeah, you could do that. Now, I typically, once I'm 53 days out, I'm not going to try to go out further than that. And again, the sweet spot is that anywhere between 45 to 60 days. That's the sweet spot for this trade. So we're in that area. And if we do get 30% within the first 3 days, and I close the entire trade out, let's say I'll still be in that sweet spot area where I just might say, okay, let me put the trade back on. It all depends on what's happening with Amazon technically. If it's still in the buy range, then I could put that trade on. If it's extended, then I'm just gonna take that 30%, move on and look for something else, because I don't want to buy anything extended. Doesn't matter if it's an option trade or you're buying the shares. If it's extended, it's extended.
Mm.
It's made its move. Move on and look for something else.